Welcome to the Property Code. I am your host, Nick. Today, our subject is how to analyze and invest in an apartment for sale. We will walk through the key factors that separate a good opportunity from a poor one and show you how to structure each deal for maximum long-term return. Emma was 29 when she first considered buying a condo unit. She lived in a midtown high-rise apartment and dreamed of turning her rent payments into equity. With $12,000 saved from freelancing and a stable job contract, she began her research. She learned that investing in apartments can deliver rental income, principal paydown, tax benefits, and future appreciation, but only if the numbers add up. Her first step was market selection. She studied neighborhoods within city limits where demand outpaced supply. She looked for areas with growing employment hubs, transit access, and improving local amenities. A neighborhood with a population around 50,000, served by light rail and 2 major employers, caught her attention. Average condo prices were rising by approximately 3% annually, and vacancy rates hovered around 4%, a sign of strong rental demand. Next, she evaluated the specific property. A 2-bedroom, 1-bath unit priced at $150,000 came on the market. She compared its price per square foot to similar listings and found it slightly below average. She examined the building's financial statements, noting monthly association fees of $300. She factored in property taxes of approximately $2,000 per year and estimated insurance at $600. Emma calculated potential rental income. She researched listings and found comparable units rented for around $1,500 per month. After deducting association fees, taxes, insurance, maintenance reserves, and property management at 10% of rent, her projected net cash flow was $250 each month. She then assessed financing terms. With a conventional mortgage at a 4% interest rate and 20% down, her mortgage payment was about $550 per month. Combining mortgage, fees, and expenses, her total monthly outlay was $750. With rent at $1,500, she still expected net positive cash flow near $700 monthly. Tax benefits also mattered. Emma would depreciate the building over 27.5 years, sheltering a portion of rental income each year. Mortgage interest and association fees were deductible. She consulted a tax professional to understand passive activity loss rules and ensure she met any material participation thresholds required to apply losses against other income. She also analyzed exit potential. Apartments in that location typically appreciated by 3 to 5% annually. She planned a holding period of 5 years to ride local market cycles. This horizon allowed enough time for principal paydown to build equity and for appreciation to compound. Finally, Emma conducted a sensitivity analysis. She stress-tested the model with a rent decrease of 10%, an increase in vacancy to 8%, and a rise in association fees by 20%. Even in the worst-case scenario, she saw modest cash-on-cash returns above 4% and equity growth over time. With the numbers validated, Emma made an offer and entered contract. She engaged an inspector, negotiated minor repairs into the seller concession, and locked in her loan at 4%. Upon closing, she listed the apartment for rent. Within 2 weeks, a qualified tenant moved in and signed a 1-year lease. If you consider purchasing an apartment for sale, follow Emma's process. Select a growing market, analyze comparable prices and rents, factor in fees and expenses, model cash flow and tax effects, plan your exit horizon, and stress test every assumption. Engage trusted advisors, real estate agents, inspectors, property managers, tax professionals, and build a buffer for vacancies or repairs. Investing in an apartment can be the gateway to building a stable, scalable real estate portfolio. It transforms rent payments into wealth-building equity and creates a reliable income stream. Thank you for listening to the Property Code. If this episode helped clarify your next steps, subscribe and share with someone ready to invest with confidence.